We pray for better days.
We're going to talk about one of my favorite indicators that I've ever come across in all of trading today. That is the moving average. It's dead simple to get your head around, even as a novice trader as well. At least I think it is. You can use it in quite a lot of circumstances to generate buy and sell signals, and some assets, their price action charts indicate with it really nicely, and they give quite strong buy signals and sell signals depending on how they interact with it, which I'll go into in just 1 second. So I've just picked any old kind of moving average here to start us off. So this is the moving average 9 and the moving average 18. So people quite often use these to generate buy and sell signals, day traders. I've picked this chart, the SPX, so it's just the S&P 500, just so I can talk you through these. So what is a moving average? Because we're on the daily chart and we've selected the moving average 9 and the moving average 18, what that means is it just takes 9 of our selected time segments, so 9 days. If it was on the 4 hour, it would be 9 4-hour sessions, so on. We're going to pick 9 days today, so it takes the previous close price of the last 9 days, divides it by 9, and then it plots a dot on the chart. So obviously that means it's a day behind, so it's a lagging indicator, okay? But that doesn't mean to say that we can't derive some useful information from it. So we picked 9 and 18. These are quite fast ones. These are for day traders and things like that. Two that I think that the SPX interacts really well with are the 22, which is basically if you take the 30 days in a month and you divide it by, well, you take away 8 because there's 4 weekends, so it's 22 working days, then it interacts really nicely with that. And then people quite often use the 50. They also use the 55. So you can see here, if we look at the chart, it's bounced so nicely off this area here on the fast line on the moving average 22. Price broke down through here. You can see it bounced right up, tried to retest it again, and it just kept going. So it just, the SPX just interacts so nicely with this line. It's really strange. On uncanny. Well, I guess it's not so strange, because if we just take away, if we take your average working month, 30 days, take away your 8 weekend days, which the SPX only trades on weekdays, then this is why it works so well for this particular one. So this is why I really like it. There's 3 different types. There's a simple moving average, exponential moving average, and weighted moving average. So we're just going to worry about the simple one today. It's the most straightforward to use. It's just your bog standard, the mean price of the last 9, 22, 50 days, whatever. The exponential and weighted ones just attach more significance to the more recent days using math. I don't really think there's that much difference in them, so I just think stick to the simple one really. So for the S&P 500, 22 and 50 are amazing. When you have one line, sell signals are generated when the price action falls below that line, okay? Because you want to short it, you want to get your shorts in here. Sell signals, buy signals are generated when it retests the line and it bounces back off, because you know that prices, that's your edge, price is more likely going to go up. That's when you use one line. Today we've used 2 lines on the chart, so you can actually use these 2 lines to generate buy and sell signals as well. So the blue line is the 22 day, the red line is the 50 day. So this is the fast line, this is the slow line, and quite often what happens is when the fast line falls below the slow line, you can see that there's a sell signal generated, and look what price did right here. It just went bam, like that. And you can even see when it's retracing, when price is coming back up again, it actually interacts really nicely with it down here. It's actually quite uncanny how well it interacts sometimes, these moving averages on the S&P 500. But obviously trading is not just as simple as just following these lines. There's other things you want to think about, but definitely these are a nice indicator that I like to use. We're going to look at a crypto now. We're going to pick ARK/BTC. No, we're not. There. We'll just pick ARK against the dollar. That'll do as well. So we're going to zoom right back out. We're still on the daily. These are the 2 best moving averages to use in crypto for your long-term holds. These are the 360, which is obviously a year, roughly. And then the 200. These are amazing. So these two lines interact really well with cryptocurrency. You can see here we haven't got enough price history to draw them further back than here. This will be the 360 because we haven't got 360 days of price history to draw the moving average until we get to this point, and this is the 200. So you can see here when they break out of these, they break out big time. Okay, obviously there's more things that you want to bear in mind purely than this for your trades, and quite often what you'll see on crypto is the 360 will be hovering just above the price action along like this, and then one day you'll get nice volume, you get a big breakout candle, and things will go boom and you're at the races. Some people buy while it's trading below the moving average, some people wait until the breakout before they buy. Either's fine, you can use either to trade successfully. It's more risk averse to wait until the breakout actually happens when you're trading these moving averages using cryptocurrency. But anyway, that's all I wanted to say. Moving averages, some of my favorite indicators in all of trading. Hope you found this video useful. Good luck and good trading. I'll see you next time. Goodbye.